Welcome back to Market on Close. Let's talk here about the big picture for the week, some bonds as well. We've got Larry Shover joining us, the CIO of Efficient Advisors. Larry, great to have you back in studio.
Thank you. Yeah.
You're always right there, but
Yes.
it's nice when you're here too. We've got Scott Connor joining us as well, of course, the host of Virtual Trade, and Alex Coffey, co-host of Fast Market. All right, so your specialty is bonds, Larry. You've been doing a great job trading these the past year and have given us some great insight. So what's going on right now? I mean, now that we're back into 10, 90-day inversion, how many times do we get to go down here or we get to wave it off? I mean, isn't there eventually we're going to have to start asking hard questions? Last time everybody kind of shrugged it off, and guess what? A month later, we're right back there.
Yeah, and I think it's all about the break-evens, something that we talked about a couple days ago on this show. Break-evens continue to go lower, and the Fed can remain on hold, can continue to say nothing and continue to say transitory, but the market's giving us a different story. And not just break-evens, but also keep in mind that through 2020, the market's implying almost 75 basis points in rate cuts. Go out to 2021, that's 65 basis points.
Yep.
So there's a nuance there that's really interesting, and it's going to be fascinating to see what the Fed does short term.
So you're with me in the agreement that the most important thing happening right now is the market's pricing in December?
Yes.
All right, there we go. I like it. All right, now we can have a talk. So the guys know that obviously I've been harping on this quite a bit. But there's also this argument out there to kind of argue against myself. There are people that say, look, there's nothing alarming going on here. There's just low inflation, and the Fed recognizes that, and the market recognizes that, and that's all they're pricing in. Fine, I get that, but there's also the idea that, why is there low inflation? And they'll say, well, it's nothing alarming either. And you go, okay, well, fine. But then that also means that if the inflation is not, some bad harbinger of the economy, okay, because it's low, well then, why would the Fed cut if the economy is doing okay? You know what I mean? So I get trapped in like this logic, basically.
Yeah, and I think the answer to that is the Fed's not, they obviously care a lot about inflation, but we're all overstating the obvious when we talk about the lack of inflation. I really think it's as simple as the growth outlook and the growth prospects going on. And we saw a global growth rebound at the beginning of the year, which has faltered off, faltered down. Our numbers are good, not great. So I think that's what the Fed's looking towards in growth.
Okay. Right now you've got GDP cuts, all right, coming across the board. JP Morgan slashes it to 1% in the second quarter. That's a pretty big sequential drop off from 3+. You add that into the equation, suddenly you start to see why maybe we need to not be so complacent about this inflation conversation if it really means GDP dropping as well. Scott, what do you think?
Absolutely, and I think that's one of the things we'll be looking forward to next week. I think we get GDP next week. I don't know if that's final Q1, but we'll have a much better idea of where GDP really was. Yeah. And I think there will be some big focus on that on the trade numbers, because we get that again next week as well, some of the international trade. So that's going to be a big focus, especially with the tariff talks going on. But you're absolutely right. If you're the Fed and you're just looking at what are we going to do with rates, even though we've told the public that we're not going to comment or say anything or commit to anything, think how long it took you as Fed members to get the rate from 0 to 2.25, 2.5. It took years. As a matter of fact, many promises were broken and they never did raise rates. They finally did raise rates. And I think that they're going to be somewhat reluctant to turn and reverse course and take them back down unless they really see something that scares them. Because I think from their standpoint, they've always argued we need bullets. We need something that we're going to be able to do if the market really turns down. We need to be able to lower interest rates. If they stay at low levels, they have no bullets, right? And we've already looked at fiscal policy. We've already had a tax cut, so no more help there either. So again, they don't want to be stuck in the position where we start lowering rates again, and if things really get out of hand, we have nothing. We have no gas pedal left. Okay.
Another way to phrase that is basically they're unlikely to do it from a preventative cautionary measure, basically.
Unless they get solid numbers that really would justify that move.
Yeah. So here's what's interesting is a lot of people would say, well, those numbers then have to be inflationary. But I would say if you actually look at the way the data, if we just pull up our economic surprise, the last time Fed basically went on hold in December, yes, we had a market that was selling off, but the language around patience came as our data was weakening quite a bit. And guess what? It's still in negative territory. It's been missing expectations, and the tick down this week showed more weak data, basically.
It has. I think it's a little bit less about that personally. I look at it, I do agree that I think the Treasury yield and the Fed not being on the same page really with the market's thinking in terms of where the rates should be is the main story, is that you're seeing the market trading off of both the 10-year yield basically and off the China headlines as they come out. But I think it's more to do with this, that it was almost an unprecedented, policy that was implemented, about 10 years ago when they brought rates down so low and they accumulated all the assets in the balance sheet. That they're trying to unwind this, and it's really a learning as they go situation.
Yeah.
But right now, the marketplace, the longer end of the curve is set by market participants, in the public marketplace. That right now is telling the Fed that they've gone too far. And to me, that's more important than what the data is saying. And you combine that with the geopolitical situation that you have right now also almost being unprecedented in terms of how many different things are going on at once. It just doesn't seem like the situation where we need to be overly hawkish, and it may be preventative from that standpoint as opposed to preventative because of inflation.
This is why I thought Mester's comments were interesting. We actually had some of the language yesterday, guys. I don't know if we can find in the control room from our hit yesterday on it. But basically what she's saying, Larry, I think goes into Alex's point, because saying, look, I get the argument, what you guys are telling us in the market, right? A 10-year at the same level as the 90-day, but it would be bad policy because we also have to think about employment. We also have to think about our other mandates, basically, of general stability that are not necessarily market relevant, right?
Right. Yeah, and I think that's why the Fed is, I shouldn't say obsessed, that's the wrong word, but I think they're focused more on growth, global growth, and our growth prospects than anything else, fully acknowledging that if you talk about inversion, the 3-month, 10-year, or whatever it happens to be, the 2-10, that ever goes inverted, it's a lot more about the growth prospects. And the longer end of the curve is something we've talked about around here for a long time, has a lot to do also with the global growth going on somewhere else, whether it be the Eurozone, whether it be Japan, because they've been continue to buy our long end of the curve, and it just keeps it where it is, and it can only go so far at this point.
Yeah. Wouldn't it also just kind of be a beauty if right when everybody's giving up on inflation, that's when it starts to kick in a meaningful way? Because I look at the company earnings we talk about, and there's a lot of companies talking about price inputs, and now you might have some artificial inflation if the tariff stuff really stays and holds.
Yeah, well, I think that's the key point. That's why everybody's on the edge of their seat, because we talked last week about, producers and are they able to pass on these prices to consumers? So far, it hasn't really, we haven't seen a big effect at that rate. But if the tariff talks keep going in this direction, we might see more of that. And then inflation, you're absolutely right, does become a different story.